All right. So to kick off, today in 2025, after decades of academic research, starting with Jensen's paper in 1968, what is the conventional wisdom on active management?
Yeah, we published a paper on that in Financial Analyst Journal a couple of years ago, where we defined the conventional wisdom of active management as the summary of a seminal paper published in 1997 by Mark Carhart. And then we summarized the conventional wisdom and then look at the last 25 years or so of academic research to see how much of that conventional wisdom has actually borne out by the new academic research. So we read hundreds of academic articles and summarized them so that you don't have to read all of them. So the conventional wisdom, as I understand it, consists of three parts. First, that the average fund, actively managed fund, underperforms after fees. Second, that the funds that may outperform, that their outperformance doesn't persist. So there's no positive performance persistence. For example, Carhart, in his 1997 paper, he concluded that any performance persistence could be explained by stock price momentum. And after investment costs were incorporated, he found that there's no predictability left. Then third, that yes, some fund managers may be skilled according to the conventional wisdom, but investors cannot benefit from such skill due again to higher costs.
Yep. Those are all arguments that we're definitely familiar with, and we've probably said many times ourselves on this podcast. So how well supported is that conventional wisdom by the academic literature?
So we looked at hundreds of papers published after Carhart's paper. First, on the notion that the average fund underperforms after fees. What we found is that many recent studies, including some of my own, found that this evidence is not that strong empirically. The underperformance of the typical actively managed fund. So in the literature, this result was based on comparing the returns of active funds to the returns of passive funds, of course. But most of this literature compared the actual returns of actively managed funds to the theoretical returns of passive funds, or of using some type of factors, benchmarks that were not actually investable, that were not tradable. What the literature hasn't really done until recently is do something that I think is very basic. That is to compare the actual returns of actively managed funds to the actual returns of passively managed funds, including the returns on ETFs. And once you do that, then the evidence that the average actively managed fund underperforms becomes much weaker or is not there on average statistically. One simple example is that many papers in the literature have used the Fama-French factors. In a separate paper I wrote with some co-authors, we find that the Fama-French factors are actually quite, we think, biased representations of the actual market in equities that mutual funds invest in. So the Fama-French factors heavily overweight small cap stocks and small value stocks, which historically have outperformed, but they're not a good representation of the equity market that mutual fund managers actually invest in. So it creates an unrealistic benchmark that's also very hard to beat, and that leads to all kinds of issues related to performance evaluation. And so the simple solution is to compare actual returns of actively managed funds to the actual returns of passively managed funds that investors would be interested in tracking. And if you do that, then again, the results of the conventional wisdom don't really hold that strongly. Then the lack of performance persistence, there's a whole bunch of papers in the literature that have found evidence for positive performance persistence of actively managed funds that survive momentum and other factor adjustments. That's the Ballen and Bussey paper from 2005, the Kozlowski, Timmerman, and Wormers and White paper from 2006. And in our own 2009 paper that introduced ActiveShare that I co-wrote with Ante Pittiisto, we found very strong positive performance persistence for equity funds with the highest active shares.
That's really interesting. That first part reminded me of the Burke and Van Binsbergen paper. I think they talk about that in with the Fama French factors not being a great benchmark. And yeah, we had them on our podcast a while ago, and I remember them talking
Oh,
about
exactly. Yeah, we cite them extensively
that. Okay,
in
yeah.
our Challenging the Conventional Wisdom paper. Yeah, they wrote some seminal papers exactly on this topic.
Interesting.
And in your opinion, Martin, does the conventional wisdom judge active management fairly?
I think in 1997, yes. But I think in the last 25 years, I think we have a lot more evidence that I think the conventional wisdom needs to be updated. That's what we try to do in our paper. At the same time, outperforming the benchmarks is incredibly difficult. Right? And financial markets, especially US equity markets, are very, very liquid, have increasingly become more efficient, more competitive, more liquid. And so there's certainly no evidence that the average equity fund in the United States outperforms after fees. Right? And it's just, or that it's easy to find funds that outperform after fees. So in that sense, I think the conventional wisdom, if that's the conventional wisdom, then that holds. But the other side is that it's all doom and gloom for active management. I think that's too negative.
Yeah, right. That's like the big question from Burke and Van Binsbergen versus Fama and French in their 2010 paper is like, are average net alphas zero or are they negative? That's kind of that question, right? Yeah.
Exactly. And my conclusion is the evidence that they're really negative is statistically not very strong. And it's easy to overturn that with different methodological adjustments or looking at different data. I think for large cap stocks, I think there is some evidence. But once you look at a broader number of investment styles, if you go to small caps, mid caps, if you go to international equities, emerging markets, but also to bonds, I think the evidence for active management is much stronger.
Yeah, we got some questions about that later. So if that's true, how does that square with Bill Sharp's arithmetic of active management, which is this kind of like, it's at least perceived as kind of a tautology that active must underperform on average?
Yes, yeah, he wrote a very influential paper on that where he argued, right, that it's a zero-sum game before fees that creates a negative-sum game after fees. A couple of years ago, Lasse Peterson, another brilliant finance scholar, he wrote a paper on this where he made, I think, a very convincing point, at least convincing to me, is that he argued that Sharpe's arithmetic of active management is implicitly assuming that we know what the market portfolio is, we know what the benchmark is, and that is basically constant. He points out, and I think rightly, that is not at all the case. The market portfolio changes constantly. Passive funds have to trade a lot too. There's a lot of things that happen in the markets. It's not a zero-sum game. And at the same time, I think that Sharpe's other point is that fees matter. Efficiency and competition are very, very important. I think those points, I think, are very well taken and remain very important.
Yeah, it's footnote 4, I believe, from Bill Sharp's paper, where he kind of acknowledges that, hey, this only holds true if nothing changes, if there's no trading. Yeah, we talked about that on a podcast recently.
How is the shift? Go ahead.
Sorry.
No, please go ahead.
No, I just wanted to acknowledge that. If you think about the market portfolio 10 years ago versus now, and if you would have just held those stocks that were in the market portfolio then versus what would have happened in the last 10 years, you would have a completely different portfolio and set of returns.
Yeah. How has the shift of investment dollars towards index funds affected the active management industry?
For US equities, it's been a very tough decade, maybe even tough 2 decades. Active managers, especially in US large caps, they have had to deal with massive aggregate outflows. And also with a large cap benchmark, think of S&P 500, that has become fairly concentrated with a relatively small number of stocks that have been driving much of the stock market performance. And so it's the shift of investment dollars away, plus a market dominated by a small number of names that I think have been particularly challenging for the active management industry, and again, especially for US large caps.
Do you have thoughts on how, like, are those flows affecting asset prices, which is then making it harder for active managers to outperform?
Yeah, that is not an area that I study closely myself. My simple intuition is there's probably got to be some demand and flow effects. Another aspect here is that a lot of the flows into ETFs are not necessarily in ETFs that have very low active share or just based on market weights. A lot of the new products that are gaining a lot of assets in the ETF space are more complex products. And many of those may not actually be that passively managed. I think of passively managed as products that really closely follow market cap weights.
Right.
Anything beyond that, in my view, already gets into active. There's so many different indices now that different ETFs follow. I do think that opportunities for active managers will improve as fewer active managers remain. But in large cap equities, markets are very competitive and efficient. There are significant opportunities elsewhere, I think, mid and small cap, value, international, emerging markets, but also other asset classes, including private assets, and of course bonds, which we may talk about later, but bond markets are a lot less liquid and efficient than equity markets.
So if the current trend toward index funds continues, are you saying that makes it a better environment for active managers, for the remaining active managers, or worse?
If for the ones that survive, it should be a better market. Because there will remain investment opportunities, especially, I think, for more patient active managers. And if the fewer of them left, it's going to be less competitive. And so I expect that those who are able to survive this massive outflow can improve their performance in the longer term.
What about the paradox of skill idea, where those, like, if there's the only two remaining active managers are both the best ones by far, the outcome of their competition becomes more driven by luck than their skill. Do you have thoughts on that?
Yeah, I don't think that skill is one-dimensional or even small dimensional. I think skill is many-dimensional. There's so many very, very complex problems that I think as a society we're trying to figure out, right? Let alone how that will affect asset prices going forward. Take something like AI or many macro things currently ongoing. So different managers may have different skills that I think can incorporate information and understand issues that in the end markets will figure out. But yeah, I don't think that markets are automatically super efficient. I think it does take real skilled analysts to analyze information and incorporate that in asset prices.
I'm curious, how do you think all of this affects the interpretation of past research on active management?
Well, the standard caveat, right? That the past doesn't necessarily predict the future. Yeah. The main way I think about it is that the past literature, and that's also how we conclude our paper on challenging the conventional wisdom, is that the past literature has very largely focused on US equities, especially large caps. And I think the future research and active management may be more fruitful, especially because, again, US equity large cap space is become so efficient and competitive, is outside that. So I think again, small caps, mid caps, private assets, bonds, other asset classes, international emerging markets. And I would think that many of the conclusions from the literature on US equities will apply to those others.